Mortgage rates tumble to all-time lows. The average rate for a 30-year conforming fixed-rate mortgage fell to a record low of 3.1% on Thursday. It came after a rocky ride that saw interest rates jump to a one-month high on the previous Friday, the day the government issued a report saying the jobless rate fell in May. That rosy data, which didn't give a true picture of the jobs market, according to the government department that issued it, sent all the investors piling into the stock market and sent bond yields soaring. Higher bond yields mean higher mortgage rates, then eventually reality set in. COVID-19 cases soared to new highs in states like Texas, Florida, and Arizona, a few weeks after aggressive measures to reopen their economies. And then investors read the footnote in Friday's unemployment report that said that the reported 13.3% rate, down from a record 14.7% in April, should have been 3 percentage points higher. There was a misclassification error in the way laid-off workers were counted, including a large number of people who were classified as employed but absent from work, when they should have been counted as unemployed. If those people had been correctly counted, the May unemployment rate would have been about 3 percentage points higher than reported. In other words, rather than falling to 13.3%, portraying a labor market on the mend, the unemployment rate would have risen to an all-time high. So once investors realized the labor market wasn't as rosy as the headline number, mortgage rates tumbled about 1/4 percentage point to Thursday's now all-time low data. Bad economic news sends investors piling into the perceived safe haven of the bond markets to snap up treasuries and mortgage-backed securities. That cranks up competition for fixed assets and thus shrinks yields. If you're a mortgage applicant who locked your rate on the day of the report or shortly after, as rates spiked to a one-month high, you might want to think about calling your lender to ask about relock options.